So today, the market's been in quite some crazy action lately. And today we're going to talk about my favorite strategy for trading today's markets. So let's just dive right in. All right, guys, so as you know, we had a really strong sell-off heading into February, and the market's basically been trading in this range ever since. So what I want to share with you guys is some types of trading action that we can look at for trading within this range. So over the last year, we've seen a number of corrections that are very similar to what we had happen this year, where we've had these really rapid sell-offs. You can see here back in May, again in June, and even in July of last year, we all had these similar types of pullbacks and similar types of correction. And after a lot of these, volatility really spiked. We started to see a lot of overlap from one trading day to the next, exactly like what we are seeing happening now, just that we're seeing it on a much larger scale this time around than we saw going into last summer. So the type of action that I trade each time, though, is really similar. When we have this type of market situation, if you're a trader like myself, where you're basically adjusting your risk per trade, meaning I don't want any one of my losers to wipe out my account completely. So I don't want to be risking more on any single trade than I do another trade for the most part. So what that means is that when you're in periods of congestion like this, where the volatility really spikes, you have to really watch what you're risking per trade compared to what you used to do before this type of volatility hit. So oftentimes that means, like, if you're trading shares, you might have to drop down and trade half as many shares as you would in your favored security compared to pre-market volatility spike. So in today's session, let me scoot on forward here, and we're going to look at some of the type of action that we will typically see with this type of market. So first of all, you have to be aware that the market corrects in two ways. We have the correction through time. Obviously, the massive drop in early February was one very clear example of when the market corrects over time, but it also corrects through price. And this comes down to watching momentum. And momentum usually determines the dominant route that we're going to see for these corrections. So when we look at a price correction in terms of a momentum move, notice this template here and pay really close attention to this exact template where you are seeing one move up, you're seeing the shift in momentum at the highs, a little bit of an additional shift in this case, drop down here, change in momentum again here, and then the continued follow through. The reason I want you to pay particular attention to this particular series of price movements is that you will see this happening over and over again in the market. And we are particularly seeing it in this market right now. So I'm going to show you guys some examples of this, even though this template is something that I drew for a class right around a year ago, when I gave the first class using this template here. But we've continued to see this price action following through over and over again in the market. So back in September, we saw one example of this intraday where we had that run up, the shift in momentum. You can see a little bit of an additional shift towards the end, drop to lows, and then another change in momentum. If I show you guys that template, notice that it's really, really similar. So as we go forward, I'm going to show you even more examples that show us what the recent action is doing and how we've had similar price development. So when we're looking at momentum and we're looking at what to trade within the current volatility, we want to look for situations where the market is basically coming into highs and lows within the congestion that's forming, or is at a midway point. These are going to be the levels that we're going to see the highest probability of success on a trade. So when we see what happened on the daily time frame, with that rapid drop here like that, and then it comes back up. This midway point, like we see on the ES, S&P 500, this is where we can get some strategies where we might have some intraday pullbacks and corrections through time. But overall, you usually get more of a correction through price. So that means that when we're at that halfway point, you have to adjust what your expectations are for a trade. So instead of trading maybe swing trades, for example, you might need to drop down and look more at an intraday time frame. Look at some of those shorter term time frames to find these strategies, as opposed to relying on the larger time frames. And keep in mind that if you are midway in that period of correction, the time correction, then that means that you're going to have more back and forth action. So instead of thinking in terms of pure Elliott wave, where you're thinking, you know, I'm looking for 3 waves this way, 3 waves that way, a lot of times what starts to happen at this point is your predominant trend moves tend to come in 2 waves. So you're more likely to see an initial drop and then a secondary continuation that's really strong. And then after that, the trend can start to shift again. So during these situations, when I'm focusing upon reversal strategies like this one that I'm showing you guys here, I tend to look for those first couple of waves of follow through on it. And as it gets into the upper end of the channel, then I'll start to look for more. I'll start to look for bigger reversals, larger corrections. We are coming into that previous high on the Russell 2000. NASDAQ is obviously already testing them. S&P 500 really isn't quite there yet. So with the difference between each of the 3 major indices, what we're going to be looking at is really dropping down to more of the intraday time frames, paying attention to the 30-minute time frame, the 60-minute time frame, and watching how momentum now starts to shift. For those of you that are Forex traders, I'll show you guys some examples of some trades in there as well. So let's look at the ES, the S&P 500 here in just a little more detail right now. So this is the 120-minute chart, and this is showing you the types of corrective moves that we've had so far. So what you'll notice is that this point here, this was about halfway back up that really large drop from February. So at this level, as momentum started to shift, it offered some intraday strategies on the short side. But since you're in that midway zone, it's harder to get extreme continued follow through. Even if this had managed to pull back down to that previous low right away, that previous low would have served as a support level, leading to another back and forth type of move. So I prefer to trade the pivots that are going to be coming off of the major lows right when it is first coming off a low to the midway point. Then I'll look for continuation moves that can happen heading in the direction that it was coming off of the low. But then I'll start to switch again, turn back around and look for reversal strategies. So I'm really playing 2 waves back and forth as the typical type of movement that I like to see. What you'll notice very quickly here is that the S&P 500 didn't hold within that typical pattern as it pulled back down. We actually ended up having 3 waves back to the downside. But still, your best chances of success are going to be to trade that first initial move and then the secondary move. If the momentum is really strong on that secondary move and is stronger than it is on the first move, that's when you can get continuation, and you can get a strong continuation at that point with a third wave. So over here, our second move is a little bit stunted. We don't quite have enough of a chance that it puts in another wave and it tries to go for a third high. Basically, if it had, we probably would have seen that momentum shifting at this point, where as it tried to go for a previous high, it would have created a trap pattern. That's what we saw happening down here, where the momentum was stronger as it went in to retest those previous lows. It was able to hit that low, but it had a harder time trying to push through it, because at that point the momentum began to shift. Even though on the smaller time frame it looks like you have a slow base and a strong continuation, At that point, if you look at the highs and your lows, you have a channel that's starting to change momentum in here. So once you get two waves on the downside within these periods of congestion on the larger time frame where you've got back and forth action, then that's where I will start to look for shifts in momentum to start to give me an opportunity to reverse the trade. So after that third wave, I'm generally not going to be trying to go for a fourth unless it's on a much smaller time frame and I have something like a really short-term intraday trade in mind, because I know that at that point there's a better chance not only that it might not even go to the previous low, but it could just shift momentum again. So after you have 2 to 3 waves of selling, if you get a bounce where you're still seeing another pattern forming at that low, the odds are greater that as it tries to go for a new low, it could just shift momentum and turn around on you. So you might not get the best follow through on it. It doesn't mean that you're not going to have cases like on the ES here, where it has a little two-wave move and it drops. And today you've got a good 20 points or so here. It can happen, but your odds of it happening have decreased. And that's what matters in the long run when you're determining which trades am I going to take, how much am I going to risk on the trades, and how do I manage the trades. If you're a newer trader and you're trying to build your confidence level and you're trying to really steadily increase your gains in your account, taking trades in the direction of the trend at this point are going to be higher risk. You're going to have higher odds of mistiming it and getting stopped out and getting flushed out. So instead, focus on looking for the pivots once you get the 2 to 3 waves of impulse moves happening on these smaller time frames. So this turned around back off of the lows, and then we had this pattern here, which is basically the reverse of what we saw on the template that I shared with you guys, except we had a little bit of a larger shift in momentum at the highs than we saw, but it fell. So the template looked like this, and then on the downside. So here's the shift in momentum, move up, basically the same type of action you had on the template, and then the continuation move on the upside. So again, you think in terms of two waves are going to have the strongest probability of giving you a good target level without the risk of a larger flush or larger correction. So the midway point is where you can often get that larger flush or larger correction. You can see that happened here with the gap down on the 7th. Now we're still in this midway channel. We started to break out higher this afternoon, going into today basically, but as we come into previous highs again, we're going to have the potential once again to see some of these reversal strategies start to form where the risk begins to drop again. So if we go and look at what typical momentum looks like, how do I determine what a typical momentum move is compared to a shift in momentum, which can tell me that I'm more likely to get a breakout or a reversal? So a typical momentum move would be if you go and look at your security that you're trading and you look at the back and forth action where you get these V pivots back and forth. That's going to give you an indication that you have a typical type of momentum move. So when a channel starts to change and no longer has that same momentum, then that's what can clue you in to larger changes that can be happening in the security, like a larger reversal or a larger breakout from a trading range. So here you can see the shift in momentum that took place. Here, popped up, continues the shift in momentum, and that allows for that stronger breakout here later on. What you can see though is that within this channel here, there's still some strong downside to start with. And there's still some strong downside moves within that range. What is important at this point though is what the overall channel is doing. If the overall channel is shifting momentum compared to what typical momentum action is, then there's going to be a higher probability that that is going to end up breaking out in the direction opposite the shift in momentum. That means if you have slow momentum on the downside, you're more likely to see that channel break on the upside. In order to get like a little bit of a more of a guarantee that that's what you're going to see happen, you can drop down to the smaller time frame charts, look for shifts in momentum that are going to be happening on the smaller time frame as well. So for example, here we had the gap down with the morning action, and it led to some slightly lower lows, but again, the momentum shifted, basically a repeat of what we saw happening over here. So that helped get this reversal going. It helped get this time correction here able to continue with the upside move that we saw happening over here. So if we look at the S&P 500 and what's going on right now, you can see that this offers up V type of action. So when I'm looking at how does current momentum play a role, I'm using this as my baseline for what the momentum is on the S&P 500. And when momentum shifts, then I'm looking for situations where it's going to break out of that shifted channel. So in many cases, that shift will be in the opposite direction of a primary impulse move. So if you've got an impulse move off of lows, the shift momentum can be a more gradual downside move that will lead to a continuation on the upside. But the market can also correct through time and not as much through price. So in this case, we've got a correction through time with a bit of a correction in price as well. Sometimes it will just correct through time and you will see it inching higher, just the momentum or the pace of that buying will slow, just like we saw on that template that I showed you guys, and just like we see on the move to the lows here. So it hit support in here and it started to correct through time by shifting the momentum as it was hitting those previous lows. So the same thing happened as we were going into today on the S&P 500. We had it coming into the upper end of the channel a couple of days ago, stalled at that channel, and then shifted momentum at that level. So originally I was looking for, okay, is this going to maybe pull back another time before we see any other major impulse moves happening? Because a lot of times that slower momentum can lead to a breakdown. But it usually happens more cleanly if it's at the upper end or lower end of the trading channel. So if you have a move up like this and a shift in momentum, if you have the previous highs, that's where it's going to be the best odds of success for a breakdown. If it's mid-range, then you have more of a chance that it could just treat it like it would a tilted bull flag or a tilted phoenix, tilted avalanche. I'll tell you guys a little bit more about the names here in just a second. So phoenix is basically your first continuation coming off of the lows. And a tilted phoenix would mean that you would be looking at something coming off the lows. You would still get that change in the channel, the change in the momentum, but you'd more likely to be able to get a secondary move. So this happens if you've got one wave off of lows or one wave with just a really short period in there. That can lead to that continuation. Again, if this is midway, I'm going to be looking for a short setup at that first pivot point for midway on the shorter time frame. But then on the larger time frame, I want to be looking for something that's going to go in the direction of where this initial impulse move was. So if we're looking at a trading channel here, for example, comes up to the midway point, you can often get shorts that can happen on the smaller time frame. The risk you run into, of course, is that after some initial action, it might go into more of a channel. So you have to hold through a lot of pullbacks and a lot of corrections in order to get that downside. So usually at that point, all I'm doing is I'm trying to trade that first initial move. I'm not holding through a lot of these corrections. Instead, I'll look for when that channel is going to end up breaking and coming out of the channel. And again, this is going to work the first time the resistance level hits. If it hits it again the second time, it's not going to work as easily. If we go and look at the euro pound, this is something that we were following yesterday in the live trading room, where it's been in a trading range for quite a while here. You can see it had an initial move to the downside that was really strong, started to shift momentum and fall into more of a channel. So we've seen this come into the upper end of that trading channel here over the last couple of weeks. And this is what caught my eye on this, because even though on this larger time frame we could be rounding off at the lows and we could actually see something like a more gradual move that might eventually break higher, at this point we have an initial move up, a secondary move up. So there was a good chance that we would see some sort of reaction off of that level. Now, the action that we got wasn't really clean. And I'm going to explain to you how we adjusted to when that action isn't clean, how to get a better trade out of it. So when we're looking at when the range hits, that V type of action will tell us that we really need to focus more upon the upper ends of the range and the lower ends of the range. And you want to watch for when the momentum starts to shift at the upper and lower ends of the range in order to get us a good trade. We saw that happening again here on the intraday. And now if we go and apply that to what was happening on the euro pound yesterday, you'll notice that on the larger 30-minute time frame, we had this stronger upside move, slower correction, again, first pivot off of the highs, offered up the best action for the downside, and then it changed momentum. So earlier in the week, we had this shift in momentum to a slightly higher high. This created a trap pattern and led to the type of pattern that we saw on the template, where it had the shift into the momentum at the highs, then following stronger upside, pulled back pretty quickly off the highs and started to fall into a trading channel. So I took this screenshot here to show you guys what this looked like when we were looking at it in the room yesterday. And basically, it was starting to form the same strategy as on the template, where we had it falling into a range here right after it came off of the highs. But what you'll notice is that it spiked really fast. And then it came back down really fast. So a lot of times this can really worry a lot of traders, and it can make them end up passing on what ends up being a really good trade. Sometimes you'll see that happening here as it goes into these higher highs too. They'll see that spike through the previous high and they'll think, oh man, even though the momentum was shifting here and it was looking like it's going to be a good short, by breaking that previous high with that little momentum spike, it means that the trade's no good anymore. And that's just not true. A lot of times that just ends up being a trap where it spikes, comes right back down, and ends up breaking lower. It'll usually pause a little bit at that previous channel low, and that's what I try to watch for. So in the room, we were talking about how it moved up so fast, moved back down so fast, and what to do at that point. It was starting to act like it could have the possibility of breaking the lower end of that trading range, but by moving lower so quickly, it meant that if it broke that trading range, it's really hitting support at that point. And it's not as likely to just continue with that move. So what I advised our traders to do was instead look for a pullback or correction that would come back into that channel, that would shift that momentum once again before we would get a continuation later on. It ended up taking until around 2:30 this morning before it ended up triggering. Fine for some of you that are over in some of our other countries there, maybe not so much for those here in the States. But you can see here now, when we go and drop down, look at this follow through here, you can see what that did was it pulled back into here, and that continued to help with that momentum shift. So overall, even though we had this spike here, the overall momentum on the channel was more of a sideways type of move. So that meant that despite that spike, I still was expecting this to continue lower because of how the momentum was shifting on the larger time frame. We'd also had the first initial move off the lows, a pullback, and so this was our secondary move into highs. We had one wave of impulse, a shorter wave of impulse, and an even shorter wave of impulse showing trend exhaustion. 2T with a slightly higher high here. This offered up the initial reversal trade that would have been, a higher probability trade other than just trading the smaller pivots. And then your next pattern is usually going to be this avalanche. And the avalanche is the opposite of the phoenix. So our phoenix happens down in here when a channel is starting to break up. This is not the prettiest phoenix, but it gives you the idea of what you would usually see. So you'll see the downtrend, you'll see a spike, you'll see a correction that hits and creates a higher low. In an avalanche, you have the opposite. You've got the move to the highs, you have the pullback, and then you have a move that will create a lower high. And as that channel breaks, that gives us that next trigger on the downside. So we go forward here, and I'm going to show you guys another example. Clear this. So here it is intraday. So what's important with looking at this and why I wanted to see another pullback and another correction into the range to get that momentum to shift was because if you don't have that momentum shifting and you look at, where you're going to get into your trade, where you're going to place your stop on your trade. Well, the only logical stop we would have if we took this channel break when it was forming, when we were first watching it, would have been to keep the stop above that high, because you don't know how far back into the channel this is going to pull before it offers a continuation on the downside. Now, by waiting, on the other hand, and looking for that smaller channel break instead, you can tighten up where you would keep your stop. So you can take the entry based upon that channel. You can keep your stop based upon that smaller bounce, that smaller high. So when you're looking at, how many contracts you can trade on something like this, and you're comparing it to your stop level, well, obviously in a situation like this, if you're keeping your risk about the same on every trade, then you can take 2 to 3 times as many contracts as you would have if you had taken it just on this pure channel break here. It still would have worked out as a trade. You still would have had a return on it, but your return would have probably been closer to like 1-to-1. So your return would have been about equal to what you would end up risking on the trade. If we look at the target level, typical target level on this strategy is going to be the 100% level. That target can change as momentum changes. So this is the chart that I grabbed here this morning as we were following through with the trade, and it was coming into my initial target, which was that 100% level. So you can see that it broke down with similar momentum compared to over here. So usually that means I'm going to be looking at that 100% level as my major initial target. Now, if momentum is picking up and it's a stronger move, then we can get continuation action. But a lot of times you'll get pauses, you'll get shifts in momentum at that point, and you'll have to expect that you might need to hold through another correction before you would have the possibility of getting that continuation. If we go and look at Kroger, this was another one we were talking about earlier in the week. This was an earnings play this week, where it had earnings coming out a couple of days ago. And going into the week, I was looking at this as, again, that same avalanche strategy. So it had the move up, it had the shift in momentum, just like the template, had the large pullback, and then was consolidating here again. The last part of the consolidation was hugging that channel even better. Now, earnings actually happened overnight here. So that meant the trigger on this on the daily time frame happened the day before earnings. But it happened with a nice gap intraday on the smaller time frame. Let me show you guys what that looks like. So, well, here's our momentum shift. And here's that intraday action. So on the intraday time frame, we had momentum continuing to shift here. So here is that channel that was forming. It popped to the upper end of the channel and then shifted, gapped down. So originally, this is something that was a gap strategy where you're now going down and looking at the much smaller time frames, looking for continuations of that. Instead of taking the pure channel break, you're able to get into that before that channel breaks because of that momentum shift. And using the gap, which shows us that the momentum is now increasing on the downside, you can get a much better entry. Now, usually I don't hold earnings things overnight, especially if I just got into the trade, because there's too much risk that I could get an adverse gap in most situations. Now, for a position trade or something like that, I'll make an exception, but for something I just entered, I don't. So this particular trade, not something I'm personally comfortable holding overnight, but you can see that it did end up following through really well on the direction of the gap. But for myself, I prefer to then go and look intraday at the smaller time frames to try to get a trade that is going to offer up that continuation. So in our group, we saw that this was following through really well. And here's where we were looking at it as the major support level. And basically that support level corresponded with the 123.6% extension. So instead of that 100% extension, the fact that the momentum increased gave us that next higher level for support. So with momentum increasing, the 123.6 often ends up being that next major level that you're going to see as support. And it also corresponded to this period of congestion over here. What happened at that point? Well, it paused the descent and started to create this congestion here. Now, you can still get continuation on this action, but usually what happens at that point is the momentum will start to shift, just like we saw on the euro pound when it hit the 100% level. And let's see, I can actually go and show you guys what that's doing now. And how that reacted. We'll look at this. Oh, it's still reacting off of that same zone. So you can see it held it almost perfectly. So if I go and add the Fibonacci, just so you can see it more clearly, whoops, going to that low. Oh, let's try again. You can see how well it held that 100% extension. So with these avalanches, that's going to be the target that I'm going for in the majority of the cases as the first initial target, where at that point, you can still get continuation on the downside, but you're usually going to have to hold through a correction first. So some traders don't want to do that. Some traders don't have a problem with doing that whatsoever. It's just going to be up to you. What are you the most comfortable with, basically? So as we look at the current market and what's happening here, we're now going to be pushing into a lot of these levels where we'll start to see more of these avalanche strategies begin to form. Here on the larger time frame, this is the Russell 2000. The reason I have this chart up here compared to the S&P 500 or the NASDAQ, which most of you guys trade a lot more often. I know I particularly trade them a lot more often than I do the Russell 2000. The reason is that it trends really well. So when I'm looking at trend development and levels of support and resistance, it actually was the one that gave a little bit of an earlier clue than the S&P 500 and NASDAQ that we were primed for that February correction, that it was basically getting ready to go because the Russell 2000 was already displaying the weakness before the S&P 500 and the NASDAQ caught up with it. So you can see that we are now on wave 2 within this channel. So as it comes up within that upper end of the channel, we should see a lot more of this type of strategy now develop and unfold. Now the NASDAQ, we're obviously creeping to newer highs here. We're retesting these previous highs. It's still a zone that we can see that those momentum reversal plays happening, these avalanche patterns happening. but we want to still be a little bit more on the cautious side because it is in that mid-range zone and it's not the first test of the resistance levels. It's not even the second test of the resistance levels. We're now going to be testing things for the third time in some of these industries and some of these indices. And so the follow through that we might get could be even smaller, meaning instead of getting like, a rapid drop like that, we might get something that's a little bit of a slower correction off of resistance levels. Now, the Russell 2000 actually has a little bit more potential. It has closer to a measured impulse move coming into those previous highs. So we might see that start to create some of the leading patterns that the rest of the market ends up also, following through. It might not be as clear cut on the other markets, but then we'll still see it following through. So let's look at some of the things that are happening recently. So right now we've got the Euro Canadian dollar is starting to follow through on a very similar pattern today. So it had a little bit more of a wedge type of formation, this declining triangle formation going into it, but still the same idea, same concept. So this is the one where we can expect that it's going to continue to try to play out in here, probably shift momentum a little bit as it does, but this is one that was moving already on the 60-minute time frame. FIZZ here is on the weekly time frame, and you'll notice that it has that same pattern. So this is another thing where FIZZ, if you're looking at swing trading, that's the type of thing that I would look for a little bit of a base or correction, pull back into the channel, something like that, that can offer up a continuation on the downside. So this is a weekly time frame. So this still has a lot more movement that it can give us. If we look at something like Facebook, we don't have a trigger yet on Facebook, but you can see the same type of action beginning to develop where it had that strong momentum move 2017, shifted momentum in the second half of the year, and then had that large drop in February just with the rest of the market. But it's holding in the lower end of that channel still and creating more of a channel. Now it's not quite ready yet. I'd like to see this bounce actually, play out a little bit longer before we could get a secondary drop. But it's something that you guys can keep an eye on where it has the same pattern that's forming, same pattern that is developing. All we need now is something to shift this momentum on the daily time frame that can allow for that trigger and allow for that follow through. So if you guys want to follow along with me and what we are doing, you can get a lot of this information by joining our League of Traders. So for the next 30 days, this is actually a free service. For about 12 years, I ran a trading room full time. It was a text-based, chat platform back then, and I ran it part-time for several more years, just as my schedule began to shift. And I've had a lot of interest in people wanting to get more of the live education, not just doing, classes and videos and things like that, but actually being able to look at things that are happening currently in the market as they're starting to unfold. So we kicked this off this week. We're kind of starting to get into our groove of things, but you guys can see some of the things that we've already been talking about. And these are major things that we've been following in the room. So the S&P 500, that Forex pair, you can see that these strategies are something that once you have the opportunity to learn and understand live why I do something or don't do something, you're going to be able to take that knowledge and apply it to your own trading as well. Whether you're trading those contracts or those markets or not, you're still going to be able to learn the strategies. So for example, where we were looking at the euro pound as an avalanche, we talked extensively about holding off and what would happen before it would trigger the trade. And we talked about this before it happened. So we were looking at it just breaking those lows just a tiny bit, pulling back up into the range, and then that it would offer the continuation later on. So to get involved with this and to have access to our live training sessions on Tuesdays and Thursdays from 9 to 11 Eastern. We've got Monday mentoring sessions at 11 a.m. Eastern on every Monday, and you'll get videos and special webinars and tutorials as well. So we have a 30-day trial right now. You guys can join for absolutely for free for 30 days. Renews typically for $97 a month, but right now, for anyone that joins us during our free trial, where we are getting into our groove of things and kind of starting to develop our system for intraday action, you can be grandfathered in and save 20%. So you can renew it at $79 a month instead of the $97. So this is something that obviously I know a lot of you guys have paid a lot more for education than this, and you haven't really been able to apply a lot of it. The people that have been in the room and that have been in the group following my trading over the years can tell you that the stuff that I'm teaching you is something that you can be able to take and apply to any market, any time frame. It doesn't go out of style. It's something if you step away from trading and you come back, you're going to be able to apply it again, just like riding a bike, step off, step back in. And it's focused upon trading pure price action. So I rely very little on learning a lot of intricate types of indicators where then you've got to figure out, okay, when do I use these indicators? When do I not use these indicators? Some things I will use to give you a little bit better visualization, like I shared with you here with the Fibonacci extensions, but you don't necessarily have to have those on your charts. You know, you could just visualize it as well. The Fibonacci can just help traders add a little bit extra visualization. So I do teach Fibonacci as well to kind of make things a little bit clearer, a little bit cleaner for some of you guys, especially newer traders. But you don't have to learn a lot of, you know, the extended indicators. If you do use indicators in your trading, basically what I'm going to teach you is when to ignore those indicators and when those indicators are going to add you that extra confirmation tool. So again, if you want to join us right now for the next 30 days, you can do so for free. And you can cancel anytime. So if it's something you decide you don't want to continue with, then just send us a message and that's it. But if you do continue, you're going to get the live trading room on Tuesdays and Thursdays. We'll be looking at everything from what swing trades are starting to develop and form to the type of intraday action that we are seeing unfold. On Monday, our Monday mentoring session, basically every session is one particular topic that I end up looking at in more detail and going into more detail on how to do it, how to trade it, what, you know, if it's something like even some of the emotional aspects of trading. So we'll be discussing that every Monday at 11 o'clock. Of course, I've got a lot of videos that are coming out as well that you guys can view, such as how to trade earnings, how to trade these gap trades like Target, like Kroger, the strategies to actually watch for. So for example, yesterday they got a video that focused upon how to trade these gaps, what the intraday action would look like in things like Kroger. So are these all recorded? Absolutely, yes. So every session is recorded, even the live trading room session, because the assumption is that most of my traders can't be there all day. They can't watch the markets all day. In fact, a lot of them are swing traders and they're not even watching the market at all during the day. They're joining because they want to learn how to apply the strategies, how to duplicate them on larger time frames, and how, you know, also what to watch for. So for example, on yesterday we talked about, you know, a number of swing trading opportunities that are starting to develop, like Facebook, and what to look for as they start to unfold. So let's see, what will I discuss this Monday? This Monday, okay, so last Monday we talked about a trading journal. And this coming Monday, what I had the traders in our group do was send me a homework assignment. Basically, they sent me a copy of one of their trades, and I'm going to go through those trades and look for some of the things that a lot of people have in common. So we'll be discussing, you know, how did the development of these trades end up following through and why. So ones that stopped out, for example, what were the reasoning What was the reasoning behind them? How, that led to the stop? What was the increased risk that was involved? So you can learn a lot of, textbook strategies by studying a lot of different sites, a lot of different books, but it's when things aren't textbook that things become more tricky, like that avalanche trade on the euro pound. So those are going to be things that we're going to be talking about. Would the program be helpful to an ES scalper? Absolutely. A lot of our traders are ES scalpers. In fact, what we're going to be doing is focusing upon just a couple of core markets during the intraday action, like the ES, like oil, and like some of our Forex pairs, where we're going to be able to follow that action intraday. And it might be on a smaller time frame than a lot of traders are comfortable trading, but it gives us the chance to follow trades from beginning to end.